Hi, I'm Dan Danford. We're doing a series of podcasts for Dad's Divorce called Money Made Easy. We take questions from a viewer and then I try to answer them as best I can. This is a really timely question this time about mortgages. How should I determine when it's a good time to refinance my house? What factors should I be looking at? Truthfully, money is a commodity. You can get it in a lot of different places. You can borrow it from a bank, you can borrow it from a mortgage broker, you can get it from a credit union, a savings and loan. I mean, there are a lot of different choices. Your best choice is the one that gives you that money at the best price, period. Money is money. It doesn't care where it came from. So a couple of things you ought to look for. One thing is look for better rates. Honestly, that is a pretty key point. Today, rates are in the upper fours. Okay, you might, if your credit's not quite so good or whatever, you might be in the fives someplace. But it doesn't really matter. Whatever your credit rating is, your rates are lower today than they have been at any time in recent history. Okay, we bought our first house in the early 1980s, and my first rate was 10.5%. Okay. So we're talking today rates that really haven't been available since the late 1950s or the early 1960s. It's an incredible opportunity to borrow money for a house. Second thing is terms. Terms are, how long you're going to pay your mortgage. The traditional payments for mortgages are either 15 or 30 years. I usually recommend to people, what you'll find out is the rate for a 15-year mortgage is a little lower than the rate for a 30-year mortgage. What I suggest to people, though, is that they take the longer term. Now, I know, some people say, oh my gosh, that just adds so much money to your mortgage. Well, a couple of things. It will reduce your payment somewhat. That's one thing. But the other thing is it gives you a lot more flexibility. Okay, with the lower payment, I don't have to be locked in. I can pay, whatever's required on the mortgage, and I don't have to pay any more if I have better uses for the money. And most families do have a lot of uses for money. So you will pay a slightly higher mortgage rate with a shorter term mortgage, but you'll also be giving up some flexibility, and I like that flexibility. Just because you have a 30-year mortgage doesn't mean you need to take 30 years to pay it off. I mean, if you come into a windfall or if you decide you want to make payments that are a little higher, you can do that if you want to, but you have the flexibility of not doing it. So my default is to take a longer term mortgage. Now, not everybody would agree with me on that, but I do think it's important. Another thing is avoid closing costs if you can. Typically when you borrow money for a mortgage, there are a couple things that have to happen. Number one is the mortgage company is going to want an appraisal on your property. They're probably going to want a new title insurance policy. They'll probably have some processing fees and things like that. But the mortgage business is so competitive that by shopping around, I think you can really reduce those closing costs. Okay? You may be able to find people with low rates and good terms that won't charge any closing costs at all. Okay? That would obviously be your best choice. Or if you have a choice between two and one is slightly higher, but it doesn't have closing costs, again, it's a flexibility issue. That might be worth considering. And a lot of it has to do with when you refinance. If you refinance at a time when things are very competitive, then you'll be able to do better against the closing costs than if you close at a time when they aren't quite so competitive. If you're at one of those times where you absolutely can't avoid them, well, look at folding them into the mortgage. In other words, say it's going to cost you $1,000 for closing costs. Well, instead of borrowing $100,000, borrow $101,000. Believe me, it won't make much difference in the long-term cost of your mortgage. Your payment isn't going to go up very much for having done that, but you're going to have increased your flexibility by not spending cash that you have in the bank today. So again, that's one other thing to consider is if I can't avoid the closing costs, can I at least fold them into the mortgage? All of this is important because, refinancing a house isn't necessarily easy. Depends on where you go, but most people, it'll take you a month or 6 weeks and you'll have to provide all kinds of financial and information to them. It's not easy and it can be expensive if you don't do it, the way I've described. But it's still worth it. Generally speaking, if you can save 1% or even 1.5% or 2% off your current loan, it'll make a huge difference in the payments and what you'll end up paying over time. Now, one more thing I want to touch on for just a second, and that is that I find that this whole issue of mortgages and refinancing houses to be an area where there's incredible what I call lore. Okay? Dad and mom and grandpa and uncle all have opinions about mortgages. Okay? They'll tell you what you should do or shouldn't do, and they'll tell you to pay off your mortgage early if you can, and they'll give you all kinds of information. I guess I'd say I think a lot of that lore is just wrong. Okay? Everybody's situation is different, and what might be right for them might not be right for you. Okay? Much of that lore comes from another point in time. But that's not today's situation. I mean, honest to gosh, most of us today, if something happened to us and our house wasn't paid for, you know, our kids are going to have a sign in the yard pretty quick to be liquidating that house. Truthfully, none of us, or few of us, are going to have our heirs want to move into our home. So if there's still a balance against it, that's fine. When the house sells, you pay off the balance and the kids pocket the difference, the equity. Okay? I mean, there isn't this compelling need to have the house paid off. The main difference is if it isn't paid off, that means you're still making payments. Again, I think there's a lot of bad lore about that. I mean, if your cost of a mortgage is in the 4% range and you take into account the tax advantages, you know, the after-tax cost of that mortgage is probably 3%. Now, in the long term, you know, you can earn more than 3% on money you're investing. Kind of a benchmark that we use when we talk about a well-diversified balanced portfolio is 8%. Now here's my question. Why would you take money out of 8% investments to pay off a 3% mortgage? It just doesn't make any sense at all. And yet that's what a lot of our parents and grandparents and aunts and uncles would encourage us to do. Now, I know that there are a lot of reasons why people are uncomfortable with debt, and I'm not saying that, you know, having a mortgage on your house is the right thing to do if it makes you uncomfortable. All I'm going to tell you is that historically, a house has been one of the most valuable assets that most families have. Okay? When you look back as recently as 20 years ago, the largest asset for most families was the equity in their home. And the reason that happened is because of a financial term we'll call leverage. It basically means that you can buy that house with borrowed money, and over time you pay down the mortgage and the value of the house increases in value. And that is a tremendous wealth builder for many families. Okay, so I'll add to the list of financial tasks that most families need to do. I'll add the list managing your mortgage. I think it's really an important thing that you manage your mortgage as just another asset in your family. And with that in mind, there are really good opportunities occasionally when interest rates dip to refinance homes and to put yourself ahead. And I honestly believe that this is one of those times. So, like I said earlier, if you haven't refinanced your house, and if you haven't bought the house in the last 6 months or a year, now is the perfect time to check into it. That's it for another week of Money Made Easy. We'll catch you next time. Thank you.